is a rental property. I keep getting these Zoom messages on my screen. The contents of this meeting has been sent to a third party. Right. Therefore, they are deductible. If the total borrowing expenses are more than $100, the deduction is spread over 5 years or the term of the loan, whichever is less. Another example is in relation to a cash flow management report. So fees for advice incurred in relation to an individual's household budgeting are considered to be private or domestic expenditure. Therefore, there's no deduction as they don't directly contribute to income generation. In terms of fees which are actually in relation to an SMSF, those are covered as well, including situations where the fee is charged to the taxpayer personally. The tax determination does make clear that fees such as those won't be deductible as they relate to a possible future investment. For example, increased contributions, and not current investment. Hence, there isn't the required link to the taxpayer's current assessable income, which will be required for the deduction to be claimed under Section 8-1. In situations where the fee is charged directly to the SMSF, then obviously the fee can't be deducted in relation to the individual because the fee relates to the SMSF and the assessable income derived or to be derived by the SMSF and not the taxpayer. I mentioned tax fees earlier on. So under a different section, we've been talking previously about Section 8.1 deductions, but under Section 25-5, a deduction is available for advice relating to managing the taxpayer's tax affairs in relation to any advice given by a recognised tax advisor. So that includes not just in relation to current investments, but also in relation to proposed investment. So any advice which is given in relation to a proposed investment by a recognised tax advisor will be deductible on Section 25-5, even if there's no deduction available on Section 8-1. And finally, the tax determination talks about the level of substantiation which will be required to support a tax deduction. So an itemised invoice, for example, a fee disclosure statement or an advice fee consent form from a financial advisor will be sufficient evidence provided it covers the following: the name of the financial advisor, the amount of the expense, an explanation of the advice provided, the date the expense was incurred, and the date that the invoice was produced. Now, I now want to talk about electric vehicles because there's a new ATO fixed rate, which is set out in PCG 2024/2. This isn't completely new. It was around last year. There was a draft PCG which was originally issued. That's now been finalised. That's PCG 2024/2. So obviously, electric vehicles are now extremely popular. There are many of them on the market. Many people are plumping for an electric vehicle. So they currently account for, I think, about 8.5% of vehicle sales in Australia, and they are rising in popularity. Now, if somebody uses one of these vehicles for work or business-related use, the question typically arises as to how they actually claim for the costs of home charging. It is possible to claim actual costs, but the compliance challenges of working that out are potentially insurmountable for most taxpayers, because working out electricity usage for the electric vehicle, it is necessary to work out the total electrical consumption of the household and then work out the electrical consumption of the electric vehicle. So it isn't typically something that taxpayers can easily do in terms of their electric vehicles. So therefore, the ATO has introduced instead a new fixed rate for electric vehicles. The methodology for calculating that fixed rate is set out within the PCG. Now, it's entirely up to the individual whether they actually use the fixed rate methodology or if they'd like to determine the tax deduction on the actual basis. However, obviously, as I've already said, the actual basis is often complicated, unwieldy, and simply not possible for many taxpayers. Therefore, if you've got an electric vehicle and you're looking to calculate a deduction for home vehicle usage, typically most taxpayers are going to use the fixed rate methodology. Now, the fixed rate methodology can be used per vehicle, and the choice to use it applies for the whole of the income or FBT year. So therefore, it isn't possible to chop and change during the year, but it can be changed by the employer or the individual from year to year. Now, for anybody who wants to use the fixed rate, there are certain criteria which need to be met. First of all, they need to be using a zero emissions electric vehicle while carrying out their income earning activities. Secondly, they need to incur electricity expenses when charging their electric vehicle at home. And thirdly, and most importantly, they need to have kept relevant records for the income year. Then quite simply, they just multiply the cents per kilometre rate, which is 4.2 cents per kilometre, by the total number of business or work-related kilometres travelled by the electric vehicle in the relevant income year, and you get your deduction that way. Now, this method can also be used in terms of charging costs which are incurred at a commercial charging station rather than at home. However, a choice does have to be made as to whether that's the most appropriate method. The EV home charging rates, the 4.2 cents per kilometre method, can be used, but only if the commercial charging station cost is disregarded. If the commercial charging station cost is used, then the EV home charging methodology needs to be disregarded in its stead. In addition, all necessary records, such as receipts, need to be kept to substantiate the claim as per the normal record-keeping rules. In terms of substantiation, where somebody intends to apply the EV home charging rate, they do need to satisfy the record-keeping requirements, which are that for cars, they need to have a valid logbook to use the logbook method of calculating work-related car expenses. And for other motor vehicles, although they don't actually need a logbook, it is recommended they keep a logbook to demonstrate work-related use of the vehicle. In addition, they need to keep at least one home electricity bill in the applicable income year to show that electricity costs have been incurred. Another piece of new ATO guidance which has recently been issued is in relation to self-education costs. So the ATO has released a new tax ruling which replaces the old tax ruling, TR 98/9, explaining what circumstances a deduction can be claimed for self-education costs. Now, there aren't any changes to the law. There aren't any real changes to ATO interpretation of the law. However, the hope is that the new ruling is actually going to be much more clear, is going to be much clearer than the old one. So the guidance obviously doesn't change the law or the ATO's practice, but it's intended to clarify and replace the existing guidance. And in addition, it's been updated to deal with recent AAT decisions and the abolition of the $250 non-deductible amount, which happened back in the 1st of July 2022. So as a reminder, I'm not going to go through the ruling in detail, but basically the ruling says that self-education costs are deductible where either of the following two situations apply. The first one is that the activity enables the taxpayer to maintain or improve the skills and knowledge which they require in carrying out their current income-earning activities. Or the activity objectively leads to or is likely to lead to an increase in the taxpayer's income from their current income-earning activities. Now, in particular, in relation to self-education claims, the ATO has recently been quite active at asking people to substantiate them by producing a document from their employer confirming that their employer believes that the course is going to be necessary in order to meet one of those two criteria. Now, we've been pushing against that in H&R Block because I don't believe it's really necessary, and indeed the tax ruling does emphasise that the fact that the self-education might be supported by their employer does not of itself make the self-education deductible. For example, a dental receptionist undertakes a certificate of dental assisting, which is supported by her employer. But the course doesn't actually meet either of the two criteria, which I talked about a few minutes ago, because it's designed to open up a new income-earning activity, and therefore the employer's support is meaningless in that situation. Now, fly-in, fly-out workers, there's been a recent tax case, the 15th of March 2024, which talks about this in the context of the company which is called Bechtel. So the full federal court in that particular case dismissed taxpayers' appeal concerning the deductibility of travel expenses for its FIFO employees, finding that the costs would not have been deductible under Section 8-1 if they were incurred personally by the employees, and therefore they weren't otherwise deductible for the purposes of the FBT legislation. Now, this court case follows on from the judgment in the earlier John Holland case. In that case, the full federal court found that travel costs incurred periodically by an employer to transport fly-in, fly-out employees from Perth to Geraldton for a rail upgrade project and back again would have been an allowable deduction to the employees under Section 8-1 if the costs had been incurred by them. So what is the difference? Well, let's just look at the particular facts of this case in more detail. So the taxpayer, which was Bechtel, carried on a business in Australia of providing contracting services in respect of large-scale construction projects. Now, one such project involved work done on a natural gas drilling project on Curtis Island in Queensland. As the Curtis Island project required a large number of employees with specialist skills and experience for a finite period, the taxpayer recruited its additional required workforce on a fly-in, fly-out basis. The FIFO employees travelled from the respective point of origin airports to Gladstone to undertake duties at Curtis Island during the period in which they were rostered on. Travel from a FIFO employee's point of origin airport to Curtis Island and back was organised and paid for by the taxpayer. Now, the taxpayer accepted that the travel expenses were potentially subject to fringe benefits tax, but argued that the taxable value of those benefits should be reduced to nil because the expenses satisfied the otherwise deductible test in the Fringe Benefits Tax Act. In other words, a deduction would have been allowable to the relevant employees in respect of travel expenses under Section 8-1 had they themselves incurred those particular travel expenses. Now, the federal court dismissed the taxpayer's appeal, with the primary judge finding that the expenditure on the relevant travel was actually a prerequisite to the earning of the employee's assessable income, not expenditure incurred in or in the course of gaining or producing such income. The court found that the earning of the employee's income actually occurred at Curtis Island, and unlike in John Holland, none of the employees here were rostered onto duty as soon as they arrived at their point of origin airport. The travel between there and Curtis Island was not, in other words, travel between two places of employment. Now, from that decision, the taxpayer appealed to the full federal court, which also dismissed the appeal, finding that the primary judge didn't err in his understanding of John Holland. He correctly identified the distinction between expenditure on travel that was a prerequisite to the earning of income and therefore not deductible on Section 8-1, and expenditure on travel incurred in or in the course of producing such income, which would be deductible on the Section 8-1, and found that the earning of the employee's income actually occurred at Curtis Island and not on the potential flights from the point of origin airport through to Curtis Island. So the full federal court found that the primary judge didn't err in concluding that the employees did not commence to perform employment duties prior to arrival at Curtis Island. So their duties were performed on and only on Curtis Island. The travel to and from Curtis Island, and in particular to and from Gladstone, didn't occur in the course of gaining or producing assessable income. And therefore the costs wouldn't have been deductible on Section 8-1, and therefore they weren't otherwise deductible for the purposes of the Fringe Benefits Tax Act. Now, the message for anybody who is looking to rely on the principles in the John Holland case, so anybody who's potentially a FIFO worker, is that they need to determine the point at which they, or indeed their employee, if it's an employer who's looking at this problem, is actually rostered on duty. So generally, a FIFO worker is considered to be rostered on duty from a location, in other words, the transit point, if it can be demonstrated that under the terms of employment, the worker is required to check in at the transit point, and the employer organises all further travel from the transit point to the work location. If the worker starts to be paid from the time that they check in at the transit point, and crucially, if the worker is under the employer's direction and control while travelling between the transit point and their work location. So if the transit point is the home airport, and the employer is indeed under the employer's direction and control for the duration of the flight, then there's a good chance that those expenses will be deductible or otherwise deductible. But if the employee isn't actually under the employer's direction and control, then typically that flight will not be tax deductible to the employee or otherwise deductible to the employer. Now back to the budget. There wasn't really much in the budget other than the personal tax cuts. However, one measure which was in the budget is an extension to the instant asset write-off. So the extension takes the instant asset write-off right through till 30th of June 2025 with a $20,000 threshold. So it's important to note that the threshold is still $20,000. You might have noticed that the House of Representatives recently threw out some Senate amendments which would have seen the threshold increased to $30,000. And in addition, the scheme applicable to businesses with a turnover of up to $50 million. That's been thrown out. The threshold is still $20,000. And it only applies to small businesses, in other words, those with aggregated annual turnover of less than $10 million. But, however, It has been extended for a further year to the 30th of June 2025. Previously, that was set to expire on the 30th of June 2024. And just a reminder, the $20,000 threshold applies on a per asset basis, and therefore small businesses can instantly write off multiple assets. If the asset is valued at $20,000 or more and can't be immediately deducted, it can be placed into the small business simplified depreciation pool and depreciated at 50% in the first income year and 30% for each income year thereafter. A few changes which are coming in to the company tax return. There are three changes which I want to talk about. The first one is in relation to the small business energy incentive. Now, that is an incentive whereby eligible businesses can claim an additional bonus deduction of 20%, up to a maximum of $20,000 for the cost of eligible depreciating assets or improvements to existing assets. So assets which are included in the new measure include upgrades to more energy efficient electrical goods. So, for example, if somebody buys new cooking equipment for their kitchen, if they're running a restaurant, and that cooking equipment is substantially more energy efficient than the previous ones, they can get they can claim the bonus deduction. Or assets which are supporting electrification, such as batteries and thermal energy storage. So, in terms of the changes to the company tax return, there's been a new label K introduced, which will be added to item 7, which is a reconciliation of the taxable income or loss, and then the new label K therefore enables the 20% tax deduction to be claimed. There's a new trust income schedule which will need to be completed and lodged by trust beneficiaries. The new schedule will replace, will replicate the fields from the statement of distribution in the trust tax return, and therefore, in relation to booking companies, this applies because they will now need to include their share of trust income to which the company is presently entitled, the company's share of frank distributions and franking credits, and the company's share of any net capital gains. Now, in addition, 4 new CGT labels are going to be added to the statement of distribution in the trust tax return. Now, I've included this amongst the business tax return changes. However, it is worthwhile pointing out this doesn't just apply to companies. All trust beneficiaries, including individuals, are going to have to complete the trust income schedule going forward. And finally, in relation to this section, in relation to the digital games tax offset, fairly niche. There won't be many companies who have to worry about this, but nevertheless, those that potentially can claim the digital tax offset might be interested in this. So companies that develop digital games can claim a 30% tax offset of up to $20 million for eligible expenditure incurred on or after the 1st of July 2022. There's to be a new digital games tax offset box on the company tax return at item 24, where there'll be 2 labels. Label A, which covers current year refundable digital tax offset, digital games tax offset amount being claimed, and label B, which covers the total amount of current year digital games tax offset already being claimed or being claimed by related companies. And finally, I want to just talk briefly about the ATO's compliance hotspots, which, usually at this time of the year, the ATO goes quite large about its compliance focus for the year ahead. And sure enough, the ATO issued a media release on the 6th of May 2024, highlighting three particular focus areas this tax time in relation to individuals. So they are incorrectly claiming work-related expenses, inflating claims for rental properties, and failing to include all income when lodging. Now, the ATO is also believed to be focusing on capital gains tax with respect to the disposal of shares and cryptocurrency. And indeed, there have been a couple of other media releases since then talking in more detail about, for example, rental properties and cryptocurrency. Looking at those three areas in a bit more detail, incorrectly claimed work-related expenses. So the ATO has announced that they found an $8.7 billion shortfall between the tax that individuals are expected to pay and the tax that they're actually paying. That's the tax gap. And they've announced that a large part of that shortfall is made up by people overclaiming deductions in relation to work-related expenses, overclaiming or indeed claiming deductions which they're not entitled to at all. So for this year, I think we can particularly expect them to focus on working from home expenses. Now, the way that these could actually be claimed changed last year. So the ATO introduced a new 67 cents per hour fixed rate. And crucially, they also introduced enhanced substantiation requirements. So I think we can expect the ATO to check claims very thoroughly. The ATO has actually said that they are going to do this, particularly to verify whether taxpayers have a record of all of their working from home hours over the entire year in the form of timesheets, a diary, or a copy of work rosters. Now, previously, taxpayers only needed to be able to produce a 4-week diary, which was then extrapolated over the entire year. Now, it's necessary to prove your entire working from home hours from the 1st of June from the 1st of July to the 30th of June. So therefore, you do need to have a diary or your timesheets or a copy of work rosters in order to claim that 67 cents per hour fixed rate. I expect the ATO to go quite large on the compliance with that requirement. Similarly, in relation to working from home, deductions for occupation costs like rent rates and mortgage insurance, mortgage interest are under the spotlight as they're not allowable unless you're actually running a business from home. In relation to mobile phone and internet costs, there's going to be a particular focus on people who are claiming the whole or indeed a substantial part of the bill for their personal mobile as work-related, and indeed for people who are potentially double dipping. So in other words, people who are claiming the 67 cents per hour working from home rate, which includes, don't forget, an element covering mobile phone costs. And then in addition, they're also claiming the mobile phone costs separately. So expect to be a real focus on mobile phone deductions, particularly where you've also claimed 67 cents per hour fixed rate working from home deduction. And in addition, motor vehicle claims where taxpayers are taking advantage of the cents per kilometre method for journeys up to 5,000 kilometres. The ATO is fairly obviously concerned that too many taxpayers are automatically claiming the 5,000 kilometre limit, regardless of the actual amount of travel, indeed, regardless of whether they're actually travelling at all. And in a similar vein, they believe that many people are claiming the work-related expenses $300 without substantiation, where they haven't actually spent anything at all. You've still got to be able to spend, you've still got to have actually incurred the expense in order to claim that. So the ATO thinks that many taxpayers are simply claiming this or an amount which is just less than $300, $298 to $299, without actually incurring the expenses at all. Inflating claims to rental properties. Let's look at that in a bit more detail. So the ATO has a particular focus on people who are claiming excessive deductions in relation to investment properties and holiday homes. This came about because the ATO announced that in a series of audits, they found that 90% of holiday home and investment properties returns, which were reviewed, actually had errors within them. So expect them to focus on excessive interest expenses claims, such as where the property owners tried to claim borrowing costs on the family home, as well as their rental property. Incorrect apportionment of rental income and expenses between owners, such as where deductions on a jointly owned property are claimed by the owner with the higher taxable income rather than simply jointly. Holiday homes that aren't genuinely available for rent. Rental property owners obviously can only claim for the periods the property is rented out or is genuinely available for rent. So periods of personal use can't be claimed. In particular, renting it out for a rent for a rate of rent which is excessively high, for example, is an indication that the property isn't actually genuinely available for rent. So the ATO has an eye on that kind of thing. And incorrect claims for newly purchased rental properties. So initial repairs claims, for example. So the cost of repairing damage existing at the time of purchase or the cost of renovation can't be claimed immediately. So initial repair costs need to be added to the cost base of the property, or indeed if the repair is actually a renovation or an improvement, again, that is subject to addition to the cost base and no deduction can be claimed for repairs. Failing to include income when lodging. The ATO is pretty convinced that many people in, for example, the sharing economy aren't properly declaring their profits and gains. Therefore, if you've got a client who's working through Uber, through Airtasker, or any of those sharing economy platforms, basically they do need to take heed. The ATO is now receiving reports from many platforms, including Uber, which you can use to highlight data mismatches. I'll talk about that in more detail on the next slide. And similarly, if a taxpayer rents out a property or part of one through Airbnb and Stays, they'll also be under the spotlight. Once again, the ATO has numerous third-party sources of data, which you can use to identify if they're receiving rent, and they're on the lookout for mismatches with the tax return data that is being reported. This is tied into the new sharing economy reporting regime, which came into force from the 1st of July 2023, or it came into force for certain platforms, such as taxi services, including ride sourcing. So that's basically Uber and all the various other ride sourcing platforms. And also for short-term accommodation, such as Airbnb, Stays, etc. So they came into force from the 1st of July 2023. In relation to all other platforms, reportable transactions need to be reported as of the 1st of July 2024. And this sharing economy reporting regime is intended to catch ride sourcing, short-term accommodation, hiring of assets, services made available through particular platforms, such as including personal assets, storage, or business space. Services which are caught could include food delivery, professional services, performing tasks and activities. And the purpose of the sharing economy reporting regime is to quite simply identify participants who fail to meet their registration or lodgement requirements, is to gain insights from the data to develop and implement compliance strategies, and is to obtain intelligence on participants in the sharing economy. So in other words, the ATO is using this as a third-party data source in order to potentially find out that the taxpayer is up to something. Therefore, if they don't disclose it, they obviously then will be subject to compliance action. You can see that the types of data which need to be reported are vast, quite frankly. There's plenty of information there for the ATO to get their teeth into. In addition, in relation to the supply of short-term accommodation, operators must provide details of property names, property address, and number of nights booked. So in terms of the implications for people who are in the shared economy, and indeed for their tax advisors, first of all, there's an ability which has been given to the ATO by the sharing economy reporting regime to pre-fill all sharing economy income. Now, I say that there's an ability. The ATO isn't currently doing that, but they will have the ability to do that if they wanted to. If this is operating as it should do, then clients won't need to be asked specifically about sharing economy income. However, for the moment, they do need to be asked because it isn't currently operating to its maximum extent. Clients may not expect to see that the ATO have such a comprehensive picture of their activities. It may be that clients have previously not disclosed that they've been operating in the sharing economy, and they may be slightly surprised to understand how much information the ATO actually has about their activities. And obviously there are implications for prior years. So if, as a result of this reporting regime, the ATO becomes aware that somebody is in the sharing economy, the question then arises, what if the sharing economy income hasn't been reported in prior years, which weren't subject to the reporting regime? Can they potentially expect some kind of audit? Cryptocurrency, another focus area as a result of the absolute boom in the number of people who are investing in things like Bitcoin. So because the number of taxpayers who are involved with cryptocurrencies has really blossomed in recent years, the ATO believes that many of them are failing to declare the profits, or in some cases the losses that they're making on their investments. So just remember that cryptocurrency can give rise to a capital gains tax on profits, where the cryptocurrency is actually disposed of. That isn't simply disposed of and converted into currency, into Australian dollars. That also involves disposing or exchanging those cryptocurrencies from one cryptocurrency to another. That all gives rise to potential capital gains tax liability. So there is potentially a quite substantial exposure, which not everybody is currently aware that they're facing. To assist them in their search, the ATO is collecting bulk records from Australian cryptocurrency designated service providers, DSPs, as part of a data matching program to ensure people trading in cryptocurrency are paying the right amount of tax. So therefore, data provided to the ATO includes cryptocurrency purchase and sale information, and the data will identify taxpayers who fail to disclose their income details correctly. Now, the ATO estimates that there are between 500,000 to 1 million Australians that have invested in crypto assets. And that estimate is actually itself a couple of years old. So the current figure could well be at the top end of that estimate, or indeed even higher. So you've got to be very aware of the potential tax exposure of cryptocurrencies. Now that's the end of my formal presentation. You can obviously, I'm happy to take questions now, or you can contact me. My details are on the slide there. However, I'll just hand you back to Teddy. And well, thanks very much for having me tonight. But I'm not sure whether there are any questions or not, but I'll just hand you back to Teddy to wrap up.
Okay. So if anyone have any question, please raise them in the chat box, or if you want to ask Mark directly, so we can let you unmute yourself and you can ask the question directly. Brenda, you got a
Hello.
question? Can you...
Hi.
Yep.
Yeah, just very quick one. On the home office fixed rate method, how detailed the diary tax office would need? So, because sometimes we can just copy and paste, right, for like 1 week to the
Oh,
other, and then
no,
just
no, no, no,
cover
no.
the
Don't
whole
do that.
year. And so,
Don't do that.
how would they check every detail, like every hour, like what we did?
Well, they'd expect that the diary would include the time that the employee started work, the time that the employee ceased work, and the time of any breaks at the minimum.
Okay.
And if you do simply cut and paste it, so that they start work at 9 o'clock every day, and they stop work at 5 o'clock every day, and they take an hour for lunch between 12 and 1. I think you can expect that the ATO will have some potentially queries about that. So it doesn't pay to simply cut and paste details. It doesn't pay in addition to
Yeah.
to simply recreate a whole year's worth of records now. This needs to be a contemporaneous record, and it needs to be detailed on a daily basis. And obviously, there can't be any claiming for periods of sick leave, annual leave, or public holidays, or Christmas, or whatever.
Okay.
So that's another dead giveaway. Somebody's claiming 52 weeks. That's
okay. So just a small, just a small add-on question. Can they claim overtime, like voluntary overtime that they're not paid for?
Well, yeah, if that's necessary for the duties of their job, if that's necessary for them to actually complete their duties, I don't see any reason why they can't claim that, because they're actually working, even if they're not getting paid for it.
Yeah. Okay, no problem. Thank you so much.
We have one question on the chat box. In your example of self-education, I was not clear with the example of receptionist taking up dental assistant course. Isn't the employer allowed to claim deduction if supporting the education to the employee?
Oh, the employer is entitled to claim it, but I was talking about an employee claiming it. So in that particular example, a receptionist is basically looking to upgrade their skills into a different role, and therefore that doesn't meet the criteria for deductibility. So it doesn't improve their current income earning capability in their current role. So a receptionist who wants to do a receptionist course can claim that, but a receptionist who wants to do a dental course can't claim that, because that's effectively a different job. There's a lot of background noise.
Yeah, there's one question. When is the SB small business and energy incentive start to be able to claim?
Sorry, I missed that. So there's a lot of background noise.
When is the small business energy incentive start to claim? I suppose when can you start claiming small business energy incentive?
Oh, I think that applies from the 1st of July 2023. However, I'm not absolutely sure about that, but I think it's the 1st of July 2023.
Okay. And follow-up question about the dental assistant. So employer can claim for supporting employee education.
Yes. Yes.
Yes. Okay. Brenda, you have a follow-up question?
Just another on that energy incentive. I just did a quick research. I couldn't find the setting date from like later. The current tax office ATO link is saying from 1st of July 2023 to June 30, 2024.
Yes.
So that means it's only covering, so installed, ready to use. That's only covering this current financial year, right?
Yes, it is. And indeed, I don't think the legislation has even passed Parliament yet, as it hasn't for the instant asset write-off. That's still going.
Yeah, it's saying that this measure is not yet law, so we can't really just start using it as law, right?
Oh well, I mean, if we take that perspective, really, it's a completely pointless measure, because realistically, there's at most 4 weeks in which businesses can use it. I would expect that the ATO would simply apply this as if it was law, even though it's potentially not law at the moment. So, and the same with the instant asset write-off. If a business has spent something during the course of the year which qualifies for the instant asset write-off, I'd expect that they would be entitled to the instant asset write-off, even though it's still working its way through Parliament.
Oh, okay. So can we start advising our clients that this can be included in a part of their tax planning strategies, or?
You can certainly advise clients, yes, with the proviso that it hasn't actually passed through Parliament just yet. I do expect that will happen before the 30th of June. However, I'm not a fortune teller. We can't absolutely guarantee that.
Yeah, that's okay. Oh, no problem. That's okay. Thank you.
Okay, anyone else have any further question for Mark before you wrap up tonight? Okay, so there's a couple of members asking for the slide to be made available through email.
Yes, I was going to say,
Okay.
I'll email you the slides immediately after this presentation.
Okay.
Distribute them.
Beautiful. All right, so if there's no other question on the chat box, so on behalf of CP Australia City Taxation Discussion Group, Henry and I would like to thank you, Mark, for your time, effort, and contribution to our group tonight. Tax time is always exciting, and so hopefully this session will prepare us and also give us insight heading into the tax season 2024. If any one of you have any further question, you can contact Mark directly. He's got his email on the screen just now, and I'm sure he'll be able to help you and your client further. So thank you all once again for attending tonight's session, and we hope to see you all back again in 2 weeks' time at CP office. And until then, please stay healthy and stay connected. Thanks, everyone. Thanks, Mark.
Thank you.